Hi friends, welcome back to FinveStocks. Today we are talking about volume. Volume is the mother of all indicators. So this is an important topic where we need to focus because volume is the key for any price action. All indicators are depend on volume. All the indicators will work fine if proper backing of volume is there. In other words, we can say the whole technical analysis is fully dependent upon volume. Even I can say volume is the key in any technical analysis. If you see the stock market, majority of stock market is ruled by smart money. Smart money means FII, money, where people can pump crores of money into stock market. So if someone can follow the smart money, then they can also make benefit out of that. So for following smart money, volume is the key because the price can be easily manipulated, but volume can't because whatever people are buying or selling will reflect in volume. So in today's video, we will talk more about volume. Stock market is not dangerous, but lack of knowledge is dangerous. So try to learn the basics of stock market before entering into stock market. So let's talk about volume first. So volume is an important indicator in technical analysis because it measures the market move. The higher the volume during a price move, the more significant the move is. Similarly, the lower the volume during a price move, the less significant is that move. Always keep that in mind. So let's see how the volume works. Suppose if a person A have 100 shares with him and similarly his friend is also having 100 shares with him. So both are engaged in a trading. So the person A wish to sell that 100 stocks wherein some buyer is required to buy that stock. Then only he can sell the stock. Assume his friend is ready to buy that stock. So he sells the stock. The same time his friend also buys that stock. Assuming both agreed on a mutual price. In that case, we'll get into a trade and the trade will be executed. Then the total volume will not be 200, it will be 100 because executed trade is 100. 100 from your side and 100 from your friend's side. Engage into a trading. So 100 selling plus 100 buying constitute one trade, that is a volume of 100, not 200. That we need to keep in mind. So let's see the volume by an example. Assume you have 3300 shares with you and you want to sell out the whole shares within that trading day. The market will open at 9:15. At 9:30, you decide to sell 400 shares from your side and some buyer is required obviously to buy that share. So you agreed for a price of 62.2 and you sold out your 400 shares and somebody bought that share. So the total volume is 400. At 10:30 you decided to sell another 500 quantity and obviously some buyers will be there and at a mutually agreed price of 62.75 you decided to sell your stock. So the trade volume here is 500. So for that day, cumulative trade volume is 400 plus 500, that is 900. Obviously, for all these shares where you are selling, some buyers need to be there and with a mutual agreed price. Assuming the whole trade executed, then the cumulative volume will be 3300. Similarly, there are n number of people who are ready to buy and sell the stock. Depends on that, the overall volume for that day will be reflected. This one is a real case wherein we can see the market watch where different companies like Cummins India, Amar Raja Battery, Thomas Cook, ITC displayed their volume chart for a particular day. So if you see the overall volume for Cummins India, the overall volume is around 12 lakhs. Similarly, for Amar Raja Batteries, it's around 2.5 lakhs. For Thomas Cook, it's 9 lakhs, and for ITC, it's 27 lakhs. So these are indicating the overall volume on particular stock for a particular day. So how can we identify the volume? Volume can be displayed in any chart. Bar chart on the bottom will indicate the volume for that particular day. Normally, high volume refers to a day's volume if that volume crosses more than last 10 days average volume. Similarly, low volume refers to that day's volume where the volume is less than last 10 days average volume. If your trade duration is higher, then you can use the default days of 20 days average. If you are a high momentum trader and if your trading frequency is high, then you can go with 10-day average volume. Average volume refers to last 10 days average volume. In this example, here we marked 50-day moving average volume. So the line represents 50-day moving average volume. So the only last blue bar which crossed the 50-day moving average line means that day's volume crossed more than last 50 days average volume. This is a typical volume chart wherein price is on the top and on the bottom is the volume against time. So in price chart, you can see blue, you can see red and green candles, which shows the price action at that particular time. For that particular time, on the bottom, the black bar shows the volume. And if you plot average volume line on the volume chart, it will show the higher towers, which indicate higher volume relative to the average. This average can be 10 days, 20 days, or 50 days moving average. The default average is 20 days. If you are a high momentum trader, you can choose 10-day moving average for quicker actions. So these are the important things to remember regarding volume. So volumes are used mainly to confirm the trend, whether it's an uptrend, downtrend, sideways trend, etc. As explained earlier, 100 shares buy and 100 shares sell will have a total volume of 100 and not 200. Towards the end of the day, the overall volume indicates cumulative volume. So whatever mentioned as volume in any chart, that indicates the overall cumulative volume on that particular day. Higher volume indicates the presence of smart money. Smart money means FII, DI, etc., wherein they will pump crores of money into the market. Low volume indicates retail participation, means people like you and me are called retailers. So if the engagement is only with retailers, the volume will be low. Huge money or huge volume will come from smart money, that is FII or DII. Before any trade, make sure that the volume confirms that trade. Avoid trading on low volume days because smart money is not participating in that. This is an important chart which shows the volume significance. So try to understand this chart and keep in mind always before doing any trade. In first case, here we explained about 4 scenarios, wherein first case the price is increasing. Similarly, along with that, volume is also increasing. In second case, price is decreasing, but volume is also decreasing. So these two patterns are bullish pattern, wherein bearish pattern is if price is increasing and volume is decreasing, it's a bearish pattern. And if the price is decreasing and volume is increasing, still it's a bearish pattern. So in the first pattern, where the price is increasing and volume is increasing, it shows some smart money is coming into that stock, which means some smart buying is happening. Just opposite to that is if the price is decreasing with high volume, then some smart money is selling that particular stock. So it is completely bearish. Similarly, low volume. Suppose the price is decreasing with low volume, that means the weak hands are selling. That is actually a bullish scenario wherein anytime it can reverse. Similarly, the price is increasing and volume is decreasing means it is the weak hands which are buying. So that also can reverse and it can turn into a bearish scenario. So always keep these 4 scenarios while doing trading. In our next video, we will talk more about volume as well as moving average, which will help in identifying some of the entry as well as exit. That's all about volume. Thanks for being with us. Have a good day.